South Africa entered the 2010s with the economic profile of a country on the edge of high-income transition. In 2011, nominal GDP was already around $420 billion, GDP per capita exceeded $7,000, and the country possessed Africa's deepest capital markets, its most industrialized base, and globally integrated corporations like Anglo-American, Sasol, MTN, Standard Bank, and Naspers. By 2024 to 2025, nominal GDP still hovers around $380 to $400 billion, meaning the economy has, effectively gone sideways for more than 10 years while population increased. Please hit the like button and subscribe to Let's Talk Africa before we dig deep into what has stagnated the South African economy for over 10 years. The first binding constraint is electricity collapse and not corruption as many would imagine. Eskom's generation capacity peaked around 46,000 megawatts in the late 2000s. By the early 2020s, available capacity frequently fell below 25,000 megawatts, despite demand exceeding 30,000 megawatts. Load shedding has directly shaved an estimated 2 to 3 percentage points off annual GDP growth. The Reserve Bank and National Treasury have independently estimated cumulative losses exceeding $80 to $100 billion since 2015. No industrial economy grows when energy supply is unreliable. Manufacturing output, which was once nearly 20% of GDP, has fallen closer to 12 to 13%, not because of global competition alone, but because factories just can't operate consistently. The second constraint is capital misallocation. South Africa still has one of the largest pools of domestic capital in the developing world. Pension funds and institutional investors manage over $500 billion in assets, yet fixed investment has collapsed from 23% of GDP in 2008 to around 14 to 15% today. This is not because money is unavailable, but because policy uncertainty and weak state capacity raise the risk premium on long-term projects. So, capital flows into government bonds, offshore assets, or short-term instruments instead of productive domestic investment. When investment falls below 20% of GDP, economies do not structurally grow, they preserve wealth while output stagnates. The third issue is logistics and network industry decay, especially rail and ports. Transnet's freight rail volumes have fallen by over 30% since 2017, forcing bulk commodities onto roads. Iron ore, coal, and manganese exports, sectors that once anchored foreign exchange inflows, are now constrained not by demand but by transport capacity. The Port of Durban regularly operates below global efficiency benchmarks, adding days and costs to trade flows. Conservative estimates place logistics inefficiencies at 5 to 7% of GDP annually, meaning South Africa effectively forfeits $20 to $25 billion per year through friction alone. No reform narrative can ignore that magnitude. Labor market rigidity has also compounded these failures. South Africa's unemployment rate has hovered between 25 and 33% for a decade, with youth unemployment exceeding 55%. This can only be described as a labor absorption crisis. Wage bargaining structures, still remain aligned to a capital-intensive high-productivity economy, but that kind of economy just isn't expanding anymore. Firms, quite rationally, respond by automating downsizing, or sometimes not investing at all. So, employment growth has basically decoupled from GDP. This creates a feedback loop where weak job creation keeps demand low, and that in turn holds back investment. The fourth structural drag is state erosion. South Africa, unfortunately, suffers from a government that just can't execute complex economic functions. State-owned enterprises, aside from a few exceptions, have really become net economic drains. Eskom, Transnet, and SAA together required tens of billions in bailouts while delivering declining services. These transfers crowd out productive public investment without improving capacity. The result is a fiscal state that spends heavily but invests weakly. Debt has risen from about 27% of GDP in 2008 to over 70%, yet growth has not followed. Finally, South Africa missed the manufacturing repositioning window. While Vietnam, Bangladesh, and parts of Eastern Europe absorbed labor-intensive manufacturing from China in the 2010s, South Africa remained stuck between high-cost industrial production and underdeveloped mass manufacturing. Export complexity. Well, it really stagnated. Non-commodity exports have persistently failed to scale. And, once manufacturing ecosystems fall behind, catching up requires coordinated energy, logistics, labor, and industrial policy, coordination that South Africa struggled to deliver during a decade of institutional weakening. The result is, honestly, an economy that still looks large on paper but no longer compounds. GDP growth has averaged around 1 to 1.5% for most of the past decade, which is actually below population growth at times. That means, well, living standards stagnated or even declined for millions. This is really why South Africa feels poorer, despite still being one of Africa's largest economies. If you like similar videos giving economic insights, please go ahead and subscribe to the channel.